Welcome to Talk Tickers, your direct line to the distilled wisdom of the latest earnings calls. Today, we are taking a look at Dragonfly Energy Holdings Corp, ticker DFLI.
Yeah, their Q3 2025 report, it just hit the wires after the close on November 14th.
And our mission for this exploration is pretty clear.
Yeah.
We're going to unpack this real tension in their report.
Exactly. You have this massive operational success story on one hand. I mean, the margin expansion, the balance sheet fix, but then it's all set against a near-term outlook that, frankly, spooked the market.
It really did. Let's jump right into that results snapshot because it is a fascinatingly mixed picture for you to consider. So starting with the bottom line, they delivered a major beat.
A huge beat.
Their GAAP EPS, that's their earnings per share, came in at negative 20 cents.
And that is so much better than the street expected. The consensus was, floating around negative 48, maybe negative 49 cents a share.
So that huge difference, it tells you that operationally, something went very, very right.
They found efficiencies much faster than anyone anticipated.
Okay, so if the bottom line was a huge beat, the top line was solid, I guess that's the word. Net sales landed at $16 million.
Which was basically right where the street expected it to be. So no big surprise there.
But it's still strong year-over-year growth, right? About 26%. So volume is definitely growing.
It is. But that massive earnings surprise came purely from efficiency and cost controls, not from a revenue beat.
And that's the good news. The challenging news and what the market really fixated on was the reaction.
Yeah, despite beating earnings by almost 30 cents, the stock, which closed around 81 cents, it dropped.
Down about 11% in after-hours trading.
The skepticism was immediate, and it was driven purely by their future forecast, not the quarter they just delivered.
Let's talk about how they actually made that $16 million, because the revenue mix here is the entire operational story. It's really a story of channel dominance.
Absolutely. The growth engine is running on one channel, and that's OEM, original equipment manufacturer.
Their OEM net sales surged. We're talking up 44.3% year-over-year to $10.7 million.
And this just validates the entire pivot the company's been making towards these bigger industrial customers.
And we're seeing real-world examples, not just abstract numbers. They confirmed their Battle-Born batteries are now standard across all of Airstream's 2026 motorized models.
That is a major win. Huge for brand validation and for volume. And they also announced a new partnership with Awaken RV.
And look at the deal with Ember RV's 2026 Overland series. That's a big expansion.
It is, because Ember isn't just adding a small battery. They're offering these larger, more complex 7-kilowatt-hour systems. That signals real trust in Dragonfly's tech.
So that's the OEM side. But the flip side to this success is the direct-to-consumer business, their DTC channel.
Yeah, that channel felt the pain of the macro environment. Sales were soft, only $5 million. That's actually down about 2.2% year over year.
Ouch.
Yeah, and management pointed directly at, challenging consumer sentiment. The backdrop for RVs right now is just tough.
When inflation bites, those big-ticket discretionary items like upgrading your RV, that's the first thing to go.
Exactly. So the key thing for you to understand here is that their high-volume B2B channel is insulating them from that consumer slowdown.
And this mix shift is exactly why the margins expanded so much. I mean, the operational leverage was just substantial.
Staggering, really. Gross margin improved by 710 basis points.
For anyone unfamiliar, a basis point is 0.01%. So that's a 7.1 percentage point expansion in profitability.
An amazing swing. It came from volume, that favorable product mix toward OEMs, and just internal cost cutting.
Which brings up the question, if margins improve so dramatically, why are they still showing an operating loss?
Fixed costs. They're absorbing massive R&D and SG&A expenses. But even with that, the adjusted EBITDA loss improved a lot.
Right. That gives us a cleaner look at their core performance.
It shrank from negative $5.5 million a year ago to just negative $2.1 million this quarter.
So the trajectory is definitely right. But the real story of Q3, it was less about the operations and more about this huge strategic move they made.
The balance sheet reset. This was the defining action of the quarter.
For so long, the shadow of their debt and this going concern anxiety was just hanging over everything. They finally addressed it head on.
And the scale of the capital raise is important context. Since July, they raised about $90 million in gross proceeds.
Through 3 separate common equity offerings.
Yes, and that caused significant dilution for existing shareholders. But, that was the price they had to pay for stability.
And stability was the goal. The debt reduction was just transformative. They slashed total debt principal down to only $19 million.
And how they did it is really worth looking at. It wasn't just paying it down.
No, it was a complex process. It included a $45 million prepayment.
But crucially, $25 million of that debt was converted into preferred equity. And maybe the most surprising part, $5 million of the debt was just forgiven.
Wow. Just wiped away.
Wiped away. And converting debt to preferred equity, that's a fascinating move. It cleans up the balance sheet, but those preferred holders get priority over common stock, like yours.
It shows the lender was willing to trade that immediate risk for a better spot in the future equity structure.
And management believes this has already solved the viability questions. They said it's translating directly into increased commercial traction.
Large OEMs, fleet customers, they need to know their suppliers will still be around in 5 years.
And you can see that confidence in the heavy-duty trucking segment. That's a huge focus for them.
They've moved several fleets from small pilot programs into expanded units. They even secured production orders from a large, nationally recognized fleet.
That jump from test to scale is critical. And the industry validation is there, too. They released a joint white paper with PACCAR.
PACCAR is one of the biggest names in trucking.
Exactly. So in the conservative trucking world, a PACCAR endorsement is basically a stamp of approval. It just unlocks major commercial doors.
Okay, so we've covered the operational wins, the strategic pivot. Now we have to talk about the guidance, which is why the market reacted so negatively.
Right. The Q4 outlook was conservative.
Very conservative. Net sales expected to be around $13 million. That's a sequential drop from Q3's $16 million.
It's still about 7% year-over-year growth, but that sequential decline is what spooked investors.
And the adjusted EBITDA forecast was also sequentially worse, expected at about negative $3.3 million.
Which confirms they missed their own target of hitting EBITDA break-even by the end of the year.
And they gave a few specific reasons for that miss.
They did. They cited a volatile tariff environment, the extended freight recession, general macro uncertainty, and one very specific thing, the U.S. government shutdown.
How did a government shutdown actually impact them?
Well, it delayed funding and certifications for several large industrial projects. These are projects that rely on federal grants or approvals.
So when the government closes, those big purchase orders just get pushed out.
Pushed right out of Q4. So the message was that profitability isn't a tech problem. It's a volume problem. It's about getting orders through the door against all this friction.
Which puts all the pressure squarely on the sales team heading into 2026.
Precisely.
Let's shift gears a bit. Let's talk about the technology, the long game. This often gets overlooked in the quarterly numbers, but it's really what defines their future value.
This area is critical. It's why investors pay a premium for a growth stock like this. They're building out their intellectual property portfolio, getting new patents.
For things like their Dragonfly intelligence platform and Wakespeed charge control tech.
Right. These are the software and controls that make their batteries smarter and safer than just off-the-shelf stuff. It's the difference between being a component assembler and a real system provider.
And they're pushing into next-gen battery chemistry, aren't they?
They are, advancing their dry electrode manufacturing processes and moving forward with all solid-state battery chemistries. Solid-state is, the holy grail for the whole industry.
And they got a nice little piece of validation for that manufacturing focus, too. A grant from the Nevada Tech Hub.
$300,000.
Yeah.
But it's more than just the money. It's confirmation. It specifically supports modernizing their Weno facility.
So if we step back, what does this all mean for you, the investor? The whole narrative around the company has fundamentally shifted.
Absolutely. The question used to be, can this company survive long enough to execute?
And that question has been answered, at least for now, by the balance sheet fix. The going concern risk is largely off the table.
So now the investment hinge is purely about execution. It's, can they scale fast enough without needing more and more dilution?
They have the tech, they have the clean balance sheet, now they just need the massive volume.
Right. And before we wrap up, we have to acknowledge the volatility here. This stock has been a wild ride, up 162% in the last 3 months.
But still down 81% over the last year. This is a high beta turnaround story.
It is. The current situation is a trade-off. Huge balance sheet cleanup, but it came with dilution and that weaker Q4 guide.
Which brings us to our final, highly speculative segment. And let's be very clear.
This is purely for discussion and education. This is not financial advice.
Okay. So given that the existential survival risk is mostly gone and the stock is trading at these distressed levels, you could argue the dilution risk is already priced in.
Right. And management is betting that their newfound stability will accelerate adoption with those big, cautious players fleets, OEMs.
So the hypothesis, based on the call, is this: that stability acts as a catalyst, and they start winning these big contracts faster than the market expects.
Proving that Q4's sequential decline was just a momentary blip, caused by temporary things like that government shutdown. We are betting squarely on the 2026 growth story.
So the strategy would be what? A high beta trade?
A high leverage trade. You could look at purchasing long-dated out-of-the-money call options, say expiring mid-2026.
And this approach limits your capital at risk to just the premium you pay for the options.
But it maximizes your leverage if there's a sharp execution-driven reversal. You're betting on them hitting that volume inflection point that management promised, and you're capitalizing on a turnaround the market seems to doubt right now.
A very focused bet on execution. So, to summarize, this quarter highlighted a real tension, incredible operational improvement versus those near-term profitability challenges and dilution fatigue.
And the final provocative thought we want to leave you with is this. Now that their capital structure is sound, how quickly can Dragonfly convert that stability into real market share against much larger, better-funded peers?
What are the market signals beyond just one-off OEM wins that will prove management's thesis correct that volume, not technology, is truly the final hurdle?
That's the core question that will define the rest of 2026.
We appreciate you joining us for this in-depth exploration of the latest financial data. Stay sharp and keep learning.